So let's just take another important aspect. Now, for markets to go to significantly higher levels, of course, there is a tailwind called politics. Of course, there is liquidity. But for liquidity to fall into place, you need global cues. US interest rates are bottoming out. Topping out. Crude has topped out. These are two important factors which in a sense are going to be important. Now my next guest on the show today, and a very dear friend of mine, Maneesh Dangi. I've learnt a lot from him over the years. He called me in September 2020 and said, okay, Nikunj bhai, it's time to buy small and mid cap stocks. And I said, nah, middle of COVID, you don't go and buy small and mid cap stocks. But his theory, which was centered around mean reversion of asset classes, has really worked like a charm. He was forefront in 2021 in calling out that interest rate spike are going to be impacting the bond market, and then we will see a big spike in bond market, and it actually happened. So his macro analysis in terms of setting the asset allocation, I think, has been right, and there's a bit of a time I think he's taking to adjust. अपनी तारीफ सुन के सब हिल जाते हैं, तो मनीष भाई भी शायद तारीफ सुन के अपनी हिल गए. आवाज आ रही है?
Hi Nikunj.
आपकी तारीफ कर रहे थे that how you've got the trends right.
आपकी तारीफ कैसे करूं मैं? आपको बधाई हो for your son's achievement in Korea on live on TV.
No, thank you very much. Your son also achieved something, so congratulations to you as well. Thank you very much. They're two proud fathers who are talking to each other. Nothing to got to show. It's our friendship, the bro bond which me and Manish actually have. Okay, markets. You are of the view that interest rate in US have peaked out. You are of the view that one should actually now bet on strength of rupee, and you are of the view that the best way to bet on asset allocation right now is to go for credit market rather than bond market. Is that Maneesh Dangi, the bond guy who's talking about credit market, or this is Maneesh Dangi, the asset allocator who genuinely feels that it's time to go to bonds?
See, basically, I mean, my general view of looking at things, and which how a commonsensical approach, Nikunj, ki jo sasta hai is you go after, and so at various point in time, Nikunj, sometimes equity, sometimes bond, sometimes credit, sometimes dollar, sometimes INR. So you sort of try and move your pack in assets in a manner that your key objective, Nikunj, is what? To do a little bit better than Nifty over long periods of time, So there are only two approaches, Nikunj, to actually outdo Nifty. One is to actually do what you sort of often talk to most of your guests, which is pick up right stocks and make a good portfolio. Another is to sort of churn from one asset to another and extract a little bit extra risk premium. So I do the latter way. And so which is why it's an asset allocator calling for, the credit risk is sort of very, very juicy right now in India. Currency, of course, I'm actually after very long, Nikunj, I've been bear INR. I mean, anytime you would have spoken to me over the last 10 years, I would have spoken against INR and for dollar. I think we are entering in a decadal, after US recession, of course, but perhaps 5-10 years of a bear market in dollar. So for the timing guy, you ought to wait a bit for US recession because US dollar is a counter-cyclical currency. But my sense is that, 5-10 years would be great for INR. That continuous 3-4-5% depreciation would pause. It will not reverse, of course, given the inflation differential, but our currency will actually be sort of rock solid for very long in whole of 2020s.
Rupee is at 82.5, almost 83. Do you see in next 3 years, it could give a CAGR appreciation of 3-4%? It could be closer to 77, 78?
No, because so see, think of it like this. Basically, rupee it has a combination. One is rate at which it is transacting vis-a-vis dollar, and then the currency and the bond yield level. So Indian bonds, of course, are higher. So so if you are a currency trader, you would look at if the currency stays stable also at this level for 5 years, you would end up making 7% in dollar versus what you're getting, let's say, 4/4 in dollar in US Treasury. So when your currency does not depreciate, it effectively means that it becomes a charm for everyone else. It's become a carry asset for you, for everyone in the world. So for a very long time, Indian currency has been steadily depreciating, especially after 2008 for good 15 years. I think we are entering in a setup in which and not lots to do with INR, but more to do with US dollar because it's exorbitantly expensive now, almost 30-35% on a PPP basis. So that's the point I'm saying that as an Indian investors, you are always worried that even though Nifty may do 15%, but if my currency depreciate by 5-10%, my net returns in dollars are low. And that's the point I've argued many times on your show. Maybe after the US recession, we will enter in a setup where, INR assets, both bond, credit, as well as equities would actually look better than dollar assets.
If one is bullish on Indian rupee, in equities you can start a SIP, but in rupee you cannot do that. You can only buy it in futures. So what's the best way to participate?
No, its best way to participate is Indian carry. Okay, so for an Indian investors, if I put out views on INR is because for the global investors that I talk to, that it's time I am actually costing them 5-6 months ahead that look, there is going to be depreciation in Indian currency for next 6 months, perhaps because of the US recession. Because as I said, US recession means counter-cyclical strength of dollar will get reflected. So Indian currency may still depreciate by 2-3%. But I am sort of simply telling every investors abroad that whoever I talk to, of course, is that now it's time to sort of begin to rethink that the 2010s won't play out in rest of 2020s. That our currency may not depreciate as steadily as it did for a variety of reasons that it did. So that's for a global investor. For local investors, this whole thing, all of us, we've discussed about it, of international investing has been because yahan hamesha currency depreciate ho jata hai. So you don't have to do it, just look for Indian carry, be it credit or Indian 2-3 year bonds, or if let's say India also starts to cite some slowdown at some point in time, then Indian bonds, 5-10 year bonds. So that's the way to sort of play this USD INR. If you're a punter or speculator on USD INR, maybe right into the recession you should go short dollar. That's the way the punter or speculator trade would be.
Or short dollar or long rupee, they both are pretty much the same coins, same sides of the same coin. Okay. So I'll wrap it up with a very quick take, maybe a 1-minute take. Today we are celebrating crude is down. We are happy that yields have come down from 5% to 4%. But is this more like a canary in a coal mine and harbinger that recession is coming around the corner? It is more dangerous than what we think.
So a US recession is bad news for US equities because the EPS are not baking in almost 10-12% increase in S&P EPS is baked into by the market, and they'll be surprised there. But US recession, if it is a soft one, which is more or less given, I've argued about it for last 2-3 months with you, is not a bad news for India, because the lot of macro unnecessary stress of strong dollar, crude would actually wither. And that would actually be a good setup for local macro, because just a small point here that Indian business cycle is at a different stage, Nikunj. Indian business cycle, we are not, if at all, we are in a little bit of a mid-cycle, whereas US business cycle is pretty stretched. So if it has a recession, India has a little bit of a dent on valuation, but from a pure economic standpoint, it's not a very bad news for economy.
It's a pleasure to have an Nitina. With the simplicity with which you always make up a complicated macro scenario for us is actually incredible. So there you go. That was Maneesh Dangi on the way how things could really evolve for the macros. Now,